Hello, Anton. You're on mute.
Okay, it sounds like I was put on mute. Can you all hear me now?
Yes.
Okay, cool. I'll start again. My apologies. Welcome to the session this afternoon. The session dealing with restarting our South African economy. My name is Anton van Wyk, partner with PwC, and I'll be your host. As some of you might have attended some of these sessions before, Lulu Krugel and her team, including Dirk Master, who will also present this afternoon, have been updating a lot of their material, and particularly now taking regard to with the restart of our economy. This session is being recorded. You'll also receive a CPD certificate afterwards for the hour that you attend the session. And if you have any questions, could I ask please that if you look on the top right-hand side of your screen, you'll see a little drop-down box to post your questions there. I will monitor those, and I'll make sure that we ask the team at appropriate intervals those questions. Lulu will take us through the first two parts of the presentation. We will then halt for a break to ask questions, and then Dirk will take us through the conclusion, and you'll have time at the end of the session to ask more questions should you so wish. There's no doubt that the dynamics of business are changing, and we're seeing on a daily basis. And I think you'll also note in the session a number of areas that I think, particularly from your perspective as NEDs, would require a lot more focus as you engage with your management teams. So with that, I'm going to hand over now to Lulu, and I'll chat to you all a little bit later when we have some of those questions ready to be asked.
Thank you very much, Anton. I'm just going to say a quick hello, and then I'm going to switch off my camera again. So as Anton has said, we are part of the economics team. I'm the chief economist for PwC in Southern Africa, sorry. And then joining me this afternoon is one of the senior economists in our team, Dirk Mostert. And just before I start now, I'm just going to ask Dirk to say hi to you, and then we will get into the presentation. So in the first part of the presentation, we're going to focus on some dynamics that we are seeing globally and how this is playing out and how it compares to what we are doing in South Africa, where we are in this process of restarting the economy. You've all heard a lot about the risk-adjusted approach that we are following to opening up the economy. And then in the second part of the presentation this afternoon, Dirk will be taking you through some of the results of the economic modeling that we are seeing based on what we know now about the risk-adjusted approach and how the different parts of the economy could open up potentially. This is really changing, I would want to say, almost on a daily basis, but there are a couple of principles that we've seen that is consistent throughout this process now and the last 2 months that we've been doing the modeling, and Dirk will be sharing that with you. So Dirk, just before I share the presentation, do you just want to say a quick hello?
Yes, thank you very much, Lulu. Good afternoon, ladies and gentlemen. Thank you for phoning in. We're looking forward to presenting this to you, and I'll be specifically taking you through the impact modeling side and the effects on different sectors. Now that will again play into supply chains, etc., and how we start to recover from this pandemic and to get the South African economy back on track again. So yeah, thank you very much.
Thank you, Dirk. Okay, so to start off, we all know that the South African economy was in a difficult position even before all of this happened. And I think whenever we look at some of the economic impact numbers that we see globally, that is something that we should keep in mind. We were in a recession. Our deficit was expected already to be close to 7% of GDP, and debt to GDP numbers were expected to climb to around 70+%. Now, obviously, that means that we have less fiscal room to move, but we've also heard a lot over the last couple of weeks in terms of what government is planning to do and lots of conversations around where are we going to get the money, etc. And I will be looking into that in a little bit more detail later. But just to set the scene, if we talk about a contraction of 7 or 8 or whatever percent in the South African economy, if you contrast that with the fact that we were expected to grow almost 0%, and then you look at contractions of 6 and 7% in other countries like the US and the UK, but of a base of around 2%, you can understand that it's kind of a similar picture that we are expecting in different parts of the world. So I think it's maybe just worthwhile to keep that in the back of your mind. So also we have seen this, we've heard about flatten the curve so much in the past, and what we do understand, definitely from what we're seeing, is the more severe the interventions from a healthcare side and in terms of containment policies and lockdown, the more severe the economic impact. And it's actually very interesting to see, that moving through the lockdown levels just a little bit faster or a little bit slower has quite a significant impact on the economy. And I think, therefore, when we get to that a little bit later on, Dirk will explain to you some of the modeling that we did. But the important thing for government is to try and get as much as possible information, in our opinion, in any event, to help them to make decisions around the healthcare side of what is happening, in conjunction with what is happening to the economy, and in order to enable us to, move towards opening up the economy and certain sectors of the economy as fast as it is safely possible to do. And I want to actually just stress that point about safely. And we by no means healthcare experts, so we're not going to say they should do X, Y, and Z. But I think it's important from a business perspective, and we are engaging, for example, through forums like Business for South Africa with government to help provide them with information to make decisions around when and how we can start opening up more of the economy. This graph here has been prepared by PwC globally, and then we included South Africa on here in terms of what we think. It's our interpretation in terms of the levels of quarantine versus, how... Hello? Was there a question? Okay, I'm going to continue then. This is just an indication of how quickly we are, or where we are in terms of the levels of quarantine or lockdown or whatever you want to call it versus the enforcement thereof. It's interesting, we looked at some of Google has very interesting data at the moment that shows the movement of people and how that has changed. And interestingly enough, if you look at that, I won't say we have the fourth strictest levels of quarantine, but at least in terms of globally how people's movement has changed, we have the fourth lowest levels of movement of people globally to places like work and malls, etc. I'm sure that might have changed over the weekend with some of the trends that we've seen. But definitely before the 1st of May, it was clear to see that we had pretty strict lockdown policies in place. Okay, so what have we seen? This is just some interesting numbers around what is happening globally in terms of COVID-19 in real economic data that we can track real time or very frequently. What you see on top there, for example, is restaurant bookings. So basically 100% decline in restaurant bookings. That's in countries like Australia, Canada, Germany, Ireland, Mexico, the UK, USA. And the number of global flights, you can see how much that has changed as well. So basically it's just a movement of cargo. And here and there, I've heard that there are some airports starting to open up. I've heard, for example, that Australia started to open up some of their airports, etc. But it's mostly at this point in time cargo, and here and there other flights for repatriating people. And I know in China there are some domestic flights that have started up again. Another interesting indicator is electricity consumption. And somebody made the calculation. It was actually in our actuarial team, one of our partners there, that told me the other day that he made the calculation, and during level 5 of lockdown, the dip in electricity consumption in South Africa equal to if we had something like stage 9 load shedding, it was equal to stage 9 load shedding. That's how much the contraction in electricity usage has been. You see there's some other countries there, the black line, that's the 2019 consumption, and that just shows you how far below that levels we are, and also that's an interesting indicator of economic activity. Retail products being sold at a discount, that for me is also very interesting. And I think if you go onto a lot of online stores in South Africa at the moment, you will see a similar trend, specifically for products that can't be delivered now. So people are heavily discounting, or companies are heavily discounting those products to sell them now, and then, you know, obviously get the revenue later. So it's interesting to see how business is responding to this. This is just some data from South Africa. As I mentioned, that Google data to just show, you know, the levels of contraction in terms of economic activity. So 50% less visits to grocery stores and pharmaceutical places. About 70% for other retail, public transport also 70 to 80%, workplaces 60 to 70%, and recreation, that was interesting, around 50%. So I don't know where people were actually you know, going, and we make the comment there around their compliance, because this is, as I say, tracked by Google, Google Earth. And as such, obviously there are still people going to parks, etc., or have been when they weren't supposed to. But it is quite interesting to actually see this, and it gives us some idea of what is happening in terms of economic activity. Another question that we often get is the lockdown versus the downgrade. So 2 downs there, and what we think the impact of the downgrade has been on the economy by Moody's. Of course, we've seen another downgrade by S&P and by Fitch as well. So both of those have us 2 notches below investment grade at the moment, and Moody's, of course, 1 notch. It's kind of gone past silently, I suppose, those other 2 downgrades, because Dirk actually explained it very well the other day. He said it's almost like standing on a beach and you have a high water mark where the water was before all of this, and that's kind of the downgrades, and now you have a tsunami called COVID-19 that's overtaking that. And I suppose the challenge that we're sitting with is that some of the impacts of the downgrades we will definitely feel if we need to go to the market after this to get additional funding. And it's going to cost us more as well, and it's going to be more difficult to actually compete with other emerging markets. But you see some interesting points there. On the top line, the All Share Index. Right after the budget speech, there was that deterioration in the global stock markets, or just before the budget speech, sorry. That deterioration in the global stock markets, it started around the 15th of Feb, 19th of Feb, and then we just followed that trend. So not necessarily something that happened specifically in South Africa. We see with the budget speech, trend kind of continued. Then there was a little bit of an uptick, and then we had our first confirmed case of COVID-19. But again, we continue to follow that international trend. And typical stock markets thought after a while, maybe we've overreacted. And then since around the middle of March, we've started to see a slight recovery there. But we basically followed international trends there. In terms of the Rand, also just interesting to see the Moody's downgrade. I suppose you can perhaps say that it quickened the pace a little bit, maybe, of the weakening in the Rand, but in my opinion, it was probably at that point in time more driven by what was happening in global markets than necessarily the downgrade. I think the noise in the global markets probably overtook that. A little bit of an appreciation after that, and yeah, the volatility in the Rand has just been astonishing basically since the beginning of the year, but since around the beginning of March, it's really picked up steam. And then of course the 10-year bond yield. So you know, we were saying, oh, obviously we think the downgrade's being priced in, but COVID-19 hasn't been priced in. If you see that break there again in the beginning of March, where the bond yields just started picking up steam as there was a moving away from emerging markets globally. And then, of course, the SARB stepped in with their open market transactions, which then brought it back into some range that's more manageable, but still above what we saw at the beginning of the year. And then, of course, after this, the fact that we have been downgraded will probably play an important role in terms of at what rate and we will get new debt in the market, and if there will be a demand. And it's really difficult at this point in time to know, because I suppose it also depends on where our competitors in other markets end up, or emerging markets. This is a very similar graph than the previous one, basically just a different way of looking at it. The outflows of equity, that's the bottom graph there. So we started the year on a negative trend as well. So the net outflows of equity, and then also the same for the bond yields. So again, it looked quite well until there at the beginning of March, end of Feb, and then also we saw the impact on our bond markets. Just the last section before we do have a bit of a break for some questions. If we look at where we are in terms of spending on COVID-19, you've heard about the 500 billion rand package, and then the Minister of Finance equating the interventions by the SARB to about another 400 to 500 billion. So we're talking R1 trillion package in some or other form. Of course, a lot of this is in the form of interventions by the SARB by cutting interest rates, open market transactions, and also the loan guarantee scheme. So not all of it is new money coming into the economy. Be that as it may, if we compare ourselves to other countries, it's equal to about 610 rand per capita, and we're kind of in the middle of that group there, which is a huge improvement from a couple of weeks ago, where we were kind of right to the bottom. So just quickly to look at that package and how we understand it. The budget expenditure will remain at just short of 2 trillion rand, with 130 billion of that being reallocated. So we thought that can't be new spending in the economy, and it is not new spending, it's money that's redirected. And you will see later when they take you through the economic impacts that we've taken that into account, because that's often a question as to, what would the impact of this be on the economy. Then in terms of tax revenue, we saw that the Commissioner actually just said earlier this morning that they expect around just short of 300 billion rand shortfall in tax revenue as a result of the lower economic growth. And you will see that our number came out to a very similar number. So also around 300 billion, and that's a combination of the tax interventions that's been announced, as well as the lower taxes or tax take as a result of lower economic growth. A lot of those tax interventions are not permanent in nature, they are just deferrals. In fact, the majority, about, I think, just short of 50 billion, that's some kind of deferral in some way, so it is payable later. And then about 20 to 30 billion, that is real tax relief. It's interesting, I spoke to some of my colleagues in Kenya, and some of the measures that they've introduced on the tax side were very much direct measures. They, for example, cut personal income tax rates and the tax brackets, and they cut VAT and so on. So much more direct interventions. Their view was that, they didn't have any room on the monetary policy side, and they didn't have mechanisms through the fiscal policy side to distribute money through grants, etc. So that was the route that they followed. So that was just interesting. So what does that budget deficit mean? So as you see there, 370 billion. That's what we got to, and that is originally, and then that goes up to 770 billion. taken into account the deficit that we would have already had, plus this new deficit on top of that, and then that takes our deficit calculation from around 7% of GDP to about 16% of GDP. So something that we will need to look into. The real injection, real money flowing into the economy in the sense of people's hands, etc., in our opinion, around 192 billion. It doesn't mean that the other interventions are not important. For example, we did take into account the interest rate interventions by the SARB, etc. And of course, all of the other interventions are really important to steady the economy, to create or to ensure that businesses don't fail, etc. But it's not a real inflow into the economy. It's redirection from other areas, etc. The funding, 130 billion from the budget, and then 170 billion from other sources, which we now understand from National Treasury, would be about 90 billion from other sources like the World Bank, the IMF, etc., and then the rest from the Unemployment Insurance Fund surplus. So I'm going to stop there just to give an opportunity for questions maybe around this first section before we move into the impact modeling.
I notice there are no questions in the little chat box. Don't forget, on the top right-hand side of your screen is a small chat box. Just open it up if you have any questions to ask of Lulu. Otherwise, you're welcome to unmute yourself. Well, I don't know if Tebogo, can they unmute themselves, or do we need to use the chat box rather?
Yes, Anton, they can unmute themselves. They just need to press the unmute button.
Thank you.
Okay, so you're welcome also to keep your questions until or discussion comments until the end when Dirk is finished. So I'm going to hand over to him now to take you through, well, I suppose the really interesting stuff in terms of the impacts that we've modeled.
Thank you, Lulu. So if we go to the first slide, so this is really just how we modeled the impacts. So what we used was what we call an input-output modeling approach, where we use a social accounting matrix. Basically, that is a matrix that looks at all the supply and demand side interactions within an economy from sectors, households, the government, etc., and how that interaction works, and that's how it's set up. And basically, it's an accounting matrix, so it comes to the correct values either from horizontally or vertically. So we use that, and it's quite a standard approach. Our colleagues in the UK followed a very similar approach, and this is to highlight what really the transmission mechanisms or channels that we focused on, is to say, what does COVID bring? What sort of disruption is this? Quite unprecedented, because, like I've said many times before in trying to explain its impact, it creates an invisible wall or a window between supply and demand. So I have money to buy something on Takealot, for instance, that I really want. They want to supply that to me, and I want to buy it, but I'm unable to. Similarly, with supply chains, there are upstream products or services that I require from overseas that I now can't get my hands on, and I can't finish my manufacturing process that I am looking after, or what my business operation depends on. Again, labor supply will be affected by this. Of course, business and consumer confidence will be affected by this. The sector lockdowns in themselves will create further burdens. We also know that, I mean, we look at these restrictions, and when these restrictions came out with the risk-adjusted levels for the various levels of lockdown, it comes with its own sort of fine print that one needs to understand, especially for businesses, as to how they can operate, if at all. And then, of course, the policy reactions. In terms of monetary and fiscal policy, Lulu just discussed that. We know that our Reserve Bank cut interest rates by 225 basis points this year already, 200 basis points really due to COVID-19, and they expect to they've got room to cut that even further. So we'll get into that as well. But of course, and I mean, I know you can all read the effect of these mechanisms on exports and imports, households, businesses, and government, of course. And then finally, impact on the financial sector. No problem, Lulu. So, and then the next slide what we did was that colorful one. Lulu, you could go to that one, the dots. Over here, we basically conducted an exercise, and I'm very happy to discuss this afterwards, or even in an email if somebody really wants the detail. But we looked at the different sectors. Now, I think we looked at about 47 subsectors or sectors in the South African economy, which ties directly into the social accounting matrix that I spoke to. And we looked at its ability to contribute to jobs. So perhaps how many of the current formal jobs in South Africa resides in each of those sectors, its contribution to GDP or gross value added or output, basically, and then its ability to create more jobs. So for each million rands invested in that sector, we call it the multiplier effect, so the GDP multiplier and also the job multiplier. So in certain sectors, they can produce a high number of jobs or output per million rand invested. So that plays a part. And then, of course, on the economic risk side, how badly was initially and is each of these industries affected by COVID-19, and these exact supply and demand impediments we just spoke about on the previous slides. And then also transmission risk in each of these industries. We took an approach to say how easy it is, how close do people need to work to each other, how close are they on the front lines, and can they do their work remotely or not. So we took some of these factors into account, and we created a scorecard. You see that on the top from 0 to 6. And then we created this slide to really look at, especially when you look at specific industries, where do they sit on this scale? Can they open up sooner rather than later? And then due to the effect of the lockdown on the economic activity or the operations, and the dire effect, like restaurants, for instance, accommodation, etc. How much would government support be required, or would they, like forestry, for instance, or fishing, agriculture, gold, be able to open up with less government support? So that is really what this slide entails. Thanks, Lulu. We can answer that question in a bit. I see Mike sent the question through. So this is the really important slide. And basically what we did was, we looked at, if you look at the left-hand side there, and you see South Africa and the 9 provinces, those percentages that we see there count up to 100%, and that is each province's contribution to the national GDP, basically, or to be technical about it, gross value added. And then we looked at and you can see on the right-hand side with all those red, all those circles, in April, the whole country, we were in lockdown. We entered from March to April, we entered from a lockdown level 5. So for April, we calculated, because for the full month of April, all 9 provinces were in lockdown level 5. And within we used the bottom-up approach for each of those sectors, and we looked and we said, okay, hotels, they won't be having any visitors because of tourism and the restriction on travel in general. Vehicle sales will be nearly 0. Retail sales, well, only these subsectors would be able to operate, but obviously not full kilter. So we made some of these judgments from a bottom-up, through a bottom-up approach, and we looked at how much would each of those subsectors and ultimately sectors contract. And that would bring us to the 37.4% contraction on that monthly basis of the economy due to the lockdown at level 5 for April. So we see that in that red bar in the middle, 37.4. It's the same number you'll see directly under that in the colored bar for April. And it's also the same, it stems from the fact that we've been in lockdown in April, all 9 provinces at the same level. So in this example, and we've done many of these examples, in this example, we looked at the latest publication. It came from on the 28th of April, last week, Wednesday, from the National Development of the Department of Health, that stated with the lockdown of 5 weeks, they estimate that optimistically we'll see the peak in June, and pessimistically around July or August. So what we've done is we've said, and based on the risk-adjusted approach that government follows currently, we put this example to the test to say, well, okay, if that does occur, if we have the peak during July, for instance, one would need to, based on the current approach, ramp up the lockdown levels back to 5 to contain the virus again, and then it'll basically require the same unlocking of the economy or moving through the different levels after that. So August, September, October, November. And in this example, you see how this plays out, and that you can also see the effect on the economy for each of those provinces, because they're not at the same level of lockdown in each month. So now we do realize there are limitations to do it in this way, but for illustrative purposes, we think it makes a lot of sense to display it this way. We understand that we won't be in a specific level of lockdown from the first of the month to the end of the month, but for such a complicated calculation, we've simplified it a bit to do it this way. And in this example, we see that if you average this contraction in the economy from where we left off in February, we end up with a 19.2% contraction over the year. Now, we know of the fiscal interventions and monetary policy interventions. You see that at the right bottom corner of a plus 1.2 percentage points that we could claw back, and then another 5.2 percentage points that we could claw back through fiscal interventions, which would bring us to minus 12.8% below where we left off pre-COVID. So Lulu started our presentation today to say that South Africa was already basically on its knees from an economic point of view when we read the budget on the 26th of Feb. So this really just shows how this exacerbates the situation. And in a number of our examples, even before we had this clear idea of the risk-adjusted approach, where we modeled our PwC model, we ran with the 5-week lockdown, and then some form of a gradual improvement that sort of resembles probably from a level 2 onwards. We came to numbers that, as our most optimistic situation, came to about 6.5%, which is roughly in line with what Treasury has put out. The contraction in GDP will be for this year. So in short, that is our approach and how we did it. And like Lulu said, we basically update this view on a daily or every 2 days, and that's how we keep tabs on this. We're not really running worst case or best case scenarios. We try to keep as close to what government puts out and what is made public, and then we say, well, based on the latest information, this is sort of where we are heading. Yeah, Lulu, I think we can move to the next slide. In this bit, we really, like I said, we then move into the sectors, and this is really an approach, the approach slide that we spoke about earlier. And perhaps, Lulu, we could pause here and ask questions or answer some of the questions, and maybe we could use the slides here in the appendix to answer some of those.
Dirk, do you mind answering Mike Leaving's question about the IT and education business sectors? Or Lulu?
Happy to do that. I didn't see the question.
The question was, where is the education business, so to speak, as well as the IT in our sectors? And so, yeah, Lulu, you're welcome to answer that question.
Yeah, so if you leave a bunch of economists to come up with classifications for business, they're not always the most sensible. So the approach that we used is based on the standard industrial classification that's used internationally. And unfortunately, or fortunately, I don't know, our national accounts are structured in the same way. So what makes it tricky, if you look at the healthcare sector, for example, it's split over 3 of these sectors. I'm just using that as an example to show you that I understand where the classification comes from, but it's not always super sensible. Healthcare, a portion of it is sitting in on the services side, which would be in community services. A portion is sitting on medical devices is in another manufacturing category, and then pharmaceuticals is in another one. And education also sits in that community services. So it's a very big sector, and it actually makes it a little bit difficult to understand because government is there, and a lot of your government services and personal and community services, etc., is lumped together in that sector. The IT, again, also IT services, and maybe I can quickly just go to that slide to just show that quickly. IT services is, let me just quickly see where that is. So there's on this slide, you will see communication, medical, and other electronic equipment. So that's communication equipment and not communication services. Communication services is on the next slide. There you see there, minus 18. Now, that's very negative, and it surprises a lot of people. And perhaps just to put that in a bit of perspective, initially when we started doing this modeling, a lot of our colleagues internationally were saying, well, the healthcare sector should come out of this okay, and IT and communication and so on should come out of this okay, because, I mean, their services are going to be used. Now, I'm not going to go into a healthcare discussion because the question wasn't around that. But if you look at what happened with communication in India and in China when they were in lockdown, we saw quite a big drop in subscribers and subscriber numbers in China. Yes, they are like us as well in terms of cell phone subscribers with more than 1 SIM card per person. So there was a lot of that. And then in India, we saw, particularly in the prepaid market, and it's still continuing, quite a big drop in what was happening there. And we initially, as I said, thought, but, you know, maybe we should, and I'm going to say it in inverted commas, override what the model is telling us here. But then eventually we decided to leave it. So if you look purely at the interconnections of the different sectors in the economy and spending on communication services that will go down if you don't have retail companies operating, etc., that is what we see coming out here, unfortunately. On the other hand, we've also seen data prices going down. So this is one I suppose we can watch, and it would be interesting to see how they develop. But yeah, we don't necessarily expect a massive positive impact for communication and /IT.
Lulu, there's a question related to that slide. If you can also discuss the finance and insurance industry.
Yeah, sure. Okay. Let me just, there's finance and insurance, also quite negative. And this is also being driven by the linkages with other sectors, how interdependent it is. I think we think the insurance side might come out of this marginally better, but again, it's difficult to say. Somebody told me the other day that during the recession or the big depression in the 1930s, what actually started the US economy again is actually the insurance sector, because people started to buy insurance against losing their jobs, and that actually started the economy. So that's just an interesting, or was part of what restarted the economy. Just an interesting comment. But obviously, the finance and insurance sector very linked to all other industries in the economy. The banking sector providing services to all kinds of businesses. And this is basically an outflow of what we're seeing there, and how business in South Africa will be negatively impacted, and how that in turn could impact the banking sector. Having said this, all of this, of course, is before specific interventions from government. It's difficult to understand how those interventions will necessarily impact specific sectors, because at this point in time, that's not how it works. So this is before interventions, but yeah, unfortunately, almost across the board, we're seeing negative impacts. And the only area where it's maybe not that negative is if you look at certain parts of the food value chain. And interestingly enough, citrus fruit, the reason why we see that negative is because of the potential loss of export market. Again, we hope that won't happen. And hopefully the demand, given how weak the rand is for citrus products, will continue to be strong. Across the board, for other areas, not so negative. Livestock, interesting, quite negative, and we're actually seeing it in the market, prices falling quite dramatically. And also, I mean, obviously with restaurants, etc., not being open, that is having an impact on certain parts of the agricultural value chain as well. But I mean, in general, the impacts for agriculture, less negative. The interesting one, the other agriculture, from what I understand from the team, that's stuff like berries and nuts and so on, and obviously more luxury products. And because people's spending patterns can change and so on, that could potentially be why we see that big negative there. So we will be sharing these slides if there are specific industries that's of interest to you.
Lulu, I think we could just add on the finance and insurance sector, and of course, a lot of the losses would be driven by individuals losing their jobs, meaning that they default on loans and loan repayments.
Absolutely.
Lulu, I don't know if you want to answer. Stuart Morris also has a question here. Under level 4, 1.5 million people have returned to the workforce. Do you have a rough indication of the incremental workers per each level, i.e. level 3, 2, and level 1?
We actually did it yesterday. I didn't put it on the slides, and it's something that I thought we should. I'm trying to remember now, and we can actually share it afterwards. But for level 5, it was only around 27%. For level 4, it's about 54%. Again, that is indicative. So it's based on people actually being able to return to work. It's not to say that they will. It takes into account, for example, some of the mines and the manufacturing sectors, etc., that can start operating. And but it's not to say that they necessarily all will do that. We know, for example, if you think about the takeaways, a lot of restaurants have decided not to go that route, and even restaurants that traditionally do provide takeaways, like Nando's, have said, no, we're not going to do that. What I'll do is, I don't have all of that at hand at the moment, but before we send out the slide deck, I'll do this slide where we have the economic impact, just add the numbers to say what share of the population will go back to work theoretically based on each of these. But for level 4, it's around 54%. Are there any other questions? Sorry.
Yeah, I don't see any posted. I don't know if you got any further slides you want to take us through, Lulu and Dirk, or?
I think the only thing that we had, Anton, was just to explain how we did that risk and value calculation. So how we came up with that matrix. And as Dirk has said, we looked at the job and GDP multipliers for the economic value. the revealed comparative advantage. Now, that is something that gives us an indication of whether or not we're well placed to export in a particular market. The contribution to GDP and jobs of the sector, and then the sector resilience. And we think that would be interesting things to keep in mind when we start looking at reopening the economy. The sad thing is, if you look purely at the economic value part of the calculation, the sector that came out tops is tourism. And it was, before all of this, really one of the sectors which we thought should be backed in terms of job creation. But now, of course, we know that's not going to happen. And but I think what we need to realize is that doesn't mean we should abandon that sector. It's something that could have potentially contributed a lot to the economy. So the question is, how do we support that sector? So when the markets start opening up and the international travel market starts opening up, a year from now, who knows, that we still have a tourism sector, because it is actually quite important. And then on the economic risk side, some of those economic impacts that we shared earlier in terms of the different impacts on the sectors, we took that into account to say how severely would the sector be impacted by COVID-19. What's the volatility in the sector? Is it a sector that performs reasonably well consistently, or is it a sector that's then up and then down, etc.? And then also whether or not there's a big risk for job losses. So in the same way that we did the impact on GDP, we did the job loss impacts and SME exposure, because we obviously want to make sure that if sectors are very exposed to SMEs, they are not necessarily the sectors that are able to carry themselves for a long time. So obviously they are more exposed to economic risk. And then based on that, we came up with that matrix in terms of focus in terms of reopening after lockdown. But to be quite honest, I also think it's very important to think about it that way. And I'm just going to go back to this quickly. When we start to think about what should our strategy be from here onwards, at least for the next 6 months or so. Obviously, after that, and that's the interesting thing, the structure of the economy might look completely different, and we won't know what things we might be able to manufacture locally, etc. So at least for the next 6 months, we think this could give us some indication of where the focus should be from government side in terms of supporting sectors, etc.
So Lulu, on that 6 months, interesting observation and question from Stuart van Graan is that he thinks the other side of the economic concern is a humanitarian concern, with a worst case of civil unrest, and he's interested to see if this was factored into your models.
No, not per se. Obviously, what I must maybe just put into perspective, we as PwC are part of a much broader conversation through Business for South Africa with government. So there are, and a lot of you might be aware of this, there are 3 work streams. The one on the economic side, where we are giving inputs. Then there's a labor side, or a labor stream, and then also a healthcare stream. So as part of all those conversations, we are in the process of looking at can we get high frequency data, because that's a problem at the moment. The macro data that's coming out from Stats SA, first of all, they can't send their normal people out to the field that they normally do, and it's delayed. So it's 3-4 months delayed by the time that we get an understanding of what is happening on the ground. So it's not factored into our model per se, and it could be a further disrupting factor, just like something like lockdown, load shedding could be. But what we are doing is we're having conversations with lots of different players in the market in terms of seeing how we can get more high frequency data to identify areas that could be potential economic hotspots in terms of social unrest, where there's already a lot of economic hardship and so on a much more micro level than what is currently available. We're also chatting to the HSRC around it because they are working on certain things, and they've already done a survey around it. So I think what we are taking to government is to say we need to understand much better, much faster what's happening on the ground so that you can react immediately. That's what we're doing on that side.
Thanks, Lulu. I don't see any more questions. Do you and Dirk want to make any closing comments?
Yeah, I think just thank you so much, everybody, for joining us this afternoon. As I said, what we will do is to add those numbers around what portion of the workforce is going back to work at what time. You also, if there's something that comes to you afterwards that you think of, please give us a shout. We're very happy to engage. And then I think the other important bit that I would just like to say is that we are continuing to engage through B4SA, Business for South Africa, to start working on how do we reopen the economy. And there's a whole range of consultancies and everybody involved in that process to see what we can do afterwards. Because the challenge is those structural problems that we had before all of this happened is not going to magically disappear. And that 16% deficit that I spoke about is something that we will have to work back, but we can't raise taxes to do that. We will have to grow ourselves out of that. So those are some of the plans that we are discussing. We are very interested to hear from you. I think most businesses are in some way already involved in that process, but if there are ideas that you would like to share, we're very happy to actually take that forward.
Lulu, considering we've still got a bit of time, Stuart has got another question here around Gauteng's contribution of 37% to our national GVA. Are there any obvious ways to accelerate parts of this economy, the Gauteng economy?
Yeah, very interesting question. So we have been working. It's basically it's the engine between the Western Cape, KZN, and Gauteng. Those are the engines of the economy. And if you start looking at more severe lockdown levels there, like we did, in the June scenario that we have there, it has quite a severe impact on the economy. So what B4SA is doing there is, first of all, there's a lot of work being done to say, from a business perspective, what are businesses willing to do and take responsibility for themselves? Because we are engaging with government at the moment and saying, if we follow your approach in terms of a risk-adjusted lockdown, we might go back to level 5 at some stage. We might move through some of these levels much slower than we are anticipating here if we apply that strictly. So one of the things that we're doing is to say, from a business perspective, what can business take care of? And say, listen, we will take responsibility for people's behavior, etc., and our employees to speed that process up. And also, again, on a micro level, to understand areas where there's high risk. And I mean, in some of the information, we are even going down to what is called an enumerated area. So that's just a little bit larger than the size of a block, to understand what is happening there. Now, obviously, you need to be very careful. You can't go to a particular area and say this neighborhood is locked down, but it does help us to understand to a much larger extent where there are less risk from an economic perspective. And what we are advocating for at the moment is to say, let's rather say or look at which sectors we cannot open than focusing the approach of which sectors we can open. And hopefully that can speed up some of the opening up of, in particular, Gauteng, the Western Cape, and KZN.
And Lulu, just your gut feel on that. I mean, if obviously if we don't open up this economy sooner, and Mike Leeming has this observation as well, we will face more serious problems than the medical problems that we face. And the lessons that you see globally, how they might apply here, and your gut feel as to when is that kind of that stopgap, so to speak, on the balance between open economy or a medical disaster.
Yeah, there's been very interesting observations made by, and I'm not a specialist or a healthcare specialist or an epidemiological specialist in any way, so I'm going to be careful and very heavily caveat my observations here. But there's been research, you probably all saw it this morning, that's been published by the Actuarial Society, where they're saying we need to be very careful because we're getting to a point where there's a potential tipping point here, where people are maybe, due to COVID-19, not getting access to other healthcare that they should get access to. There's also the question, at what point are the economic hardships to such an extent that it is threatening lives as well, in terms of malnutrition, not access to food, etc. So that is a difficult question to actually answer. But the thing is, what we're trying to do, at least from B4SA side, and I'm not going to claim that the two of us on this call has the information or knowledge from that, but in terms of the actuarial and healthcare modeling, etc., again, we're going to government armed with as much as possible information to help them to make decisions. Because, and this is my opinion, if we follow the route that we are on at the moment, we are up for extremely difficult times economically, which we are going to struggle to recover from. We're going to lose jobs, and it could be in the region of around 4 million jobs that we could lose, and people actually, you know, not getting access to that, to other healthcare, etc. So the question is, the real difference in terms of the impact actually starts when you start moving to level 2. You know, that's really an improvement in the economy. How quickly can we get there, and in which way can we use business, and business actually taking responsibility for their own people to get them to that level 2 as quickly as possible.
Thanks, Lulu, and thank you as well to everybody on this video con. Lulu and Dirk, thank you for your presentation. As most of you know, we are doing these on an ongoing basis. There are other more general presentations that we'll be delivering over the next couple of weeks. Some dealing with the board's role in this changing environment, and obviously updates on what Lulu and Dirk have presented today. So thank you all very much for attending, and I wish you a happy afternoon. Cheers all.
Thank you.
Thank you.
Thank you. Bye-bye.